You're watching Silver News Daily. Subscribe for more.
Did you know that silver could be the next big thing in the world of precious metals, potentially skyrocketing in value? But here's the catch. Major banks and financial powerhouses might be keeping this from happening. You see, while gold is grabbing all the headlines, silver is quietly being manipulated to stay undervalued. But what if I told you that the BRICS nations are planning something that could flip the script entirely, sending silver prices through the roof? Stick around, because what I'm about to reveal could change the way you think about silver forever.
Right, or partly right. That's a big factor in where we've come so far. The mining investors, those that are really involved on a day-to-day basis, have been involved in the sector, have been really just hit upside the head by a 2x4 every time they gained any conviction in a market rally, and we've seen sell-off after sell-off. And a really choppy rise over the last couple of years. That's part of the story. The other part of the story is mainstream or mining investors have never seen the factors that were driving gold earlier in the year happen before. They were confident in a Fed pivot. That's the kind of a factor or driver that they could understand and project forward by a couple of years. Once the Fed starts cutting rates, they don't stop for a long time, or they cut rates in an emergency fashion right down to zero, which I think is going to happen at some point. But what was driving the gold price at first wasn't understood at all. Then it came out that it was central banks, and central banks were buying at such a feverish pace that investors really couldn't count on that pace continuing. And in fact, we saw that China over the last couple of months, at least publicly, has refrained from announcing any gold purchases. So understandably, the investors in the mining sector weren't willing to dive headfirst in the pool once again. Now I think that's changing. And in fact, I think it's the generalist investors that are going to start really moving at things right now, because the factor of Fed pivot, again, is something that's easily understood and projectable. We're seeing that right now. Most people aren't aware that the mining stocks, at least as rated by the big gold miner indices, had actually been outperforming gold for most of this rally, but not as much as we would have expected it to. Now that's starting to change. We're starting to see not only the big miners, but the juniors really start to move. And I think what I've termed a generational window of opportunity still exists, but not for long. To get these great companies at current prices is an opportunity I think everybody needs to take advantage of while they still.
Despite offering many of the same benefits as gold, silver has been struggling to keep up with its more glamorous counterpart in recent years. This isn't just a fluke or a coincidence. There are deeper, more sinister forces at play here. Silver, often dubbed the poor man's gold, has historically been seen as a more accessible investment option, particularly for those who might not have the capital to invest heavily in gold. Yet, despite its affordability and its crucial role in various industries, silver's price has been consistently suppressed, leaving many investors scratching their heads. Why, in a world where gold continues to soar, does silver lag behind so dramatically? The answer lies in a complex web of market manipulation, largely orchestrated by major banks and financial entities that have a vested interest in keeping silver's price low. These powerful players have been using various tactics, including massive short positions in the futures markets, to artificially suppress the price of silver. For years, these manipulations have gone largely unchecked, creating an environment where silver's true potential is stifled. The disparity between gold and silver prices has grown to unprecedented levels, making it clear that something is very wrong. Take, for instance, the gold-to-silver ratio, which currently hovers around 86:1. Historically, this ratio has been much lower, often closer to 15:1 or 30:1. This wide gap suggests that either gold is overvalued, or more likely, that silver is significantly undervalued. When we look at the market forces behind these numbers, It's clear that silver isn't getting a fair shake. This isn't just an oversight. It's a deliberate act by financial entities who stand to gain from keeping silver prices down. But why would these institutions want to suppress silver prices? The reasons are multifaceted. For one, silver's lower price makes it less attractive to investors compared to gold, driving more capital into gold and other assets that these financial entities may be more heavily invested in. Moreover, the suppression of silver also benefits industries that rely heavily on silver as an industrial metal, keeping their costs lower and profits higher. This manipulation creates an artificial environment where silver is kept from reaching its true market value, allowing these entities to maintain control over both the financial and industrial markets. Industry experts like Ryan London have often pointed out that this suppression isn't just about controlling prices in the short term. It's about maintaining a broader control over the market. According to London, silver's role as both an industrial and monetary metal makes it uniquely susceptible to this kind of manipulation. He notes that while gold is often seen as a hedge against inflation and economic instability, silver's dual role means that it is targeted not just by financial institutions, but also by industries that depend on its relatively low price for manufacturing processes. The ongoing manipulation has also created a sense of disillusionment among investors who recognize silver's potential but are frustrated by its stagnant price. Many have started to question whether silver is a good investment at all, due to its lackluster performance compared to gold. But as London and other experts argue, this current underperformance is not reflective of silver's intrinsic value or its future potential. It's a result of systemic manipulation. As we continue to explore the dynamics at play, it's important to understand that this struggle between gold and silver is not just about market prices. It's about power and control. The institutions manipulating silver prices are doing so to maintain their dominance in the financial markets, to ensure that they can continue to profit at the expense of ordinary investors. But as we'll see in the next steps, this delicate balance is on the brink of disruption.
Beginning in 1971. Previous to that, it was widely considered as money, and not so widely considered, but considered by me and some others at least as money since. But still, you could not invest in, it wasn't a risk asset, an investable asset until 1971. Since then, we've had three big bull markets, but we've never seen in any of those markets, bull markets, we've never seen Asian investors, particularly Chinese investors, buy on the way up. They usually buy on price declines. They've exhibited bargain hunting characteristics in the past, and which has been helpful because it supported the gold price on price declines. But in this case, they have been buying as the price has gone up for a number of reasons that we might want to get into later. But that's a new thing. We haven't seen it before. Now, we're seeing, and typically in those previous bull markets, it's been the Western investors that have bought on the way up, chased the price higher. Now we're seeing that big factor of a Fed pivot come into view, and this is bringing the Western investors in because, again, that's a trend they understand, and they're going to start chasing the price higher. The fascinating thing, and I think the exciting thing that I see is that this doesn't mean that the Asian investors are going to stop buying. In particular, central banks, which aren't that price sensitive, may not stop buying either. So if we have Asian investors, the East buying gold, and we have the West buying gold at the same time, that's going to be something that we've never seen before. And the reaction in the gold price could be truly explosive if that develops. It may be happening literally as we speak. Over the next few weeks, we'll see more data come out as far as Asian buying, and I'm very curious to see what that's going to show. One of the reasons why Asian investors have been buying, particularly Chinese investors have been buying so heavily, is that they don't really have any alternatives. The Chinese stock market has been in the dumps. The Chinese real estate market has a number of problems that are well known. And those are the two primary investment markets of Chinese savers and investors. and they look at gold as some form of savings. That's why they buy it on price declines. They put money away and hoard it in gold. Uh, they don't have other alternatives to this. That's why they are buying or have been buying the price on the way up. They're starting to get that kind of FOMO, that investing fever for gold. And I think they don't look at, they kind of sense that the opportunity to put their money away at lower prices is fleeting.
The manipulation of silver prices by major banks and financial institutions isn't just a theory. It's a well-documented practice that has had a profound impact on the silver market for years. These financial giants have been employing a range of tactics to keep silver prices suppressed, effectively controlling the market to serve their interests. One of the most significant tools at their disposal is the futures market, where they have been shorting silver on a massive scale. By doing so, they can artificially drive down the price, creating an illusion of lower demand or higher supply than actually exists. Short selling in the futures market involves borrowing silver contracts with the promise to sell them at the current price and then repurchasing them later, ideally at a lower price, before returning them to the lender. When done on a small scale, this is a standard trading practice, but when executed on the scale seen in the silver market, it becomes a powerful tool for price manipulation. These banks, with their immense resources, are able to flood the market with short contracts, overwhelming natural buyers and driving prices down. This suppression not only affects current silver prices, but also sends a signal to the market that silver is not a good investment, thus deterring potential investors. Brian London, an astute observer of the precious metals markets, has often highlighted how this manipulation distorts the true value of silver. According to London, the disparity between the physical silver market, where actual silver is bought and sold, and paper market, which involves trading in silver futures, is stark. In the physical market, demand remains strong, especially with silver's critical role in various industrial applications, from electronics to renewable energy technologies. Yet this demand is not reflected in the paper market due to the overwhelming influence of these large financial institutions. London explains that this manipulation is a major reason why the gold-to-silver ratio is so skewed. Normally, if silver were allowed to trade freely without interference, its price would rise significantly due to its industrial demand and the broader economic factors that influence precious metals. However, because these financial entities can manipulate the paper market so effectively, silver remains undervalued. This is not just an issue for speculators or investors. It affects industries and consumers who rely on silver for its various applications, driving a wedge between the true market value of silver and its manipulated price. The consequences of this manipulation are far-reaching. Investors who are new to the market, or who do not fully understand the dynamics at play, may be discouraged by the low returns on silver, leading them to invest elsewhere. This, in turn, perpetuates the cycle of low demand and low prices, allowing the manipulators to continue their practices unchallenged. Meanwhile, those who understand the game being played, like Brian London, realize that this presents a unique opportunity. As London points out, the more these institutions suppress silver, the greater the potential for a massive price correction when, not if, the manipulation ends. There have been instances where the manipulation has come under scrutiny, with lawsuits and fines levied against some of the major players involved. For example, J.P. Morgan has faced accusations and penalties related to its activities in the silver market, yet these fines are often just a slap on the wrist compared to the profits gained from such manipulation. The persistence of these practices, despite regulatory actions, highlights just how deeply ingrained and lucrative this manipulation has become. But what happens when these manipulations can no longer hold? London and other experts believe that the market is nearing a tipping point. The sheer volume of physical silver being consumed for industrial purposes, coupled with the growing interest in silver as an investment hedge, is creating a situation where the price suppression might soon become unsustainable. When that happens, we could see silver prices skyrocket as the market corrects itself, much to the detriment of those who have been betting against it. This potential for a dramatic price shift is precisely why savvy investors are keeping a close eye on the silver market. They understand that while the current situation appears bleak, it is precisely this kind of manipulation that creates opportunities for significant gains. As more and more investors wake up to the realities of the silver market, the pressure on these financial institutions to unwind their positions will increase, potentially triggering a rapid rise in silver prices.
Treasuries in whole, and it's not going to assume a leadership position in foreign reserves in the near future. But you see treasuries falling, and it's a fairly steep line as a percentage of those reserves, and you see gold rising. The gold has just recently surpassed the euro as a component in foreign reserves. And it's interesting to me when you see mainstream financial media report on foreign reserves, they usually list the dollar, the euro, and the yen, and maybe a few other minor currencies, but they don't typically list gold. And that's another case of how, listening to podcasts like you, looking at the alternative media out there, you see the real story that's really being obscured by the mainstream financial media. The role of gold is rising in international finance, central bank finance, monetary policy. And that should be somewhat disturbing to the U.S. So from that standpoint, I can see some potential manipulation emerging, but I think the gold market itself has just gotten too large, and the upside momentum has gotten too great for even central bank forces that would be fighting against gold to manage, because most central banks now are actually buying gold.
As we've explored, silver has been held down by manipulative practices in the futures markets, largely driven by major financial institutions. However, the global landscape is shifting, and one of the most significant developments on the horizon is the increasing influence of the BRICS nations: Brazil, Russia, India, China, and South Africa. These countries are not only challenging the dominance of Western financial institutions, but are also taking bold steps to reassert control over their own economic destinies. One of the most intriguing and potentially game-changing moves they are considering involves the revaluation of silver, a decision that could completely upend the current market dynamics. The BRICS nations have been vocal about their dissatisfaction with the current global financial system, which is heavily influenced by the U.S. dollar and the Western banking system. In response, they have been working towards creating an alternative financial system that reduces their reliance on the dollar. This includes discussions about creating a new reserve currency backed by a basket of commodities, including precious metals like silver. If the BRICS nations move forward with this plan, the impact on silver prices could be monumental. Brian London has often emphasized that silver's role as both an industrial and monetary metal makes it uniquely positioned to benefit from such a geopolitical shift. He notes that while gold is traditionally viewed as a safe haven asset, silver's dual functionality gives it an additional layer of strategic importance, particularly for countries looking to diversify away from the dollar. For the BRICS nations, revaluing silver would not only bolster their economic independence, but also provide them with a valuable asset that could serve as a foundation for their new financial system. Imagine the implications if these countries, collectively representing a significant portion of the world's population and economic output, decided to formally revalue silver. Such a move would likely involve large-scale purchases of silver to back their currencies or reserves, driving up demand and consequently the price of silver. This would not only disrupt the manipulation efforts by Western banks, but also signal to the world that silver is an asset of strategic importance, leading to a global revaluation of its value. The revaluation of silver by the BRICS could serve as a catalyst for a broader market correction. As London points out, once a major player like China starts aggressively buying silver, it could set off a chain reaction in the market. Other countries, seeing the potential benefits, might follow suit, leading to a rapid increase in silver prices. This would be particularly impactful because it would represent a shift in the balance of power in the global financial system, away from Western dominance and towards a more multipolar world order. Moreover, this revaluation wouldn't just be about raising the price of silver. It would also reflect a deeper strategic shift in how these nations view their economic sovereignty. By tying their currencies to tangible assets like silver, the BRICS nations would be making a bold statement about their intent to move away from the fiat-based monetary systems that have dominated global finance for decades. This could lead to a reemergence of precious metals as key pillars of global finance, with silver at the forefront. For the average investor, the implications of a BRICS-driven revaluation of silver are profound. If these nations succeed in their efforts, we could see silver prices rise to levels that reflect its true value, unburdened by the artificial constraints imposed by market manipulators. This would validate the positions of those who have long believed in silver's potential and create significant opportunities for those who are positioned to take advantage of the price surge. However, as London wisely cautions, such a dramatic shift in the market could also bring volatility. Investors would need to be prepared for rapid price movements and the possibility of backlash from Western financial institutions that have long benefited from the status quo. This potential for volatility underscores the importance of staying informed and being ready to act as the situation evolves. In conclusion, the BRICS nations' potential revaluation of silver represents a pivotal moment in the global financial system. It's a move that could break the stranglehold of manipulation that has kept silver prices low for so long, unleashing its true market value. For investors who understand the dynamics at play, this could be a once-in-a-lifetime opportunity to benefit from a market correction of historic proportions. As we continue to watch how these developments unfold, one thing is clear. Silver's story is far from over, and the next chapter could be its most exciting yet.
Bug compadres on this subject. I think you have to compare the U.S. dollar with all of the other available um, alternatives and competitors. A BRICS currency, I think, is somewhat unworkable. It's also going to be managed by economies and governments that don't have much in the way of rule of law. And in the U.S., as much as we can criticize the rule of law in the U.S., it's still the best around. So I don't think that the U.S. dollar is going to lose its reserve currency status in any kind of a time frame that matters to us. In other words, in our investing lifetimes. However, I do recognize that there is a trend toward away from the U.S. dollar and trying to get out from under the yoke of the U.S. dollar hegemony by a number of countries, not just Russia, but also China and really central banks around the world that are buying gold quite enthusiastically right now. And in fact, the dollar's share of global reserves is falling while gold's is rising very steeply. I don't think they're going to cross at any point in time, but I think any near point in time, but I think they are going to cross eventually.
Silver isn't just a precious metal. It's a critical industrial resource, and this dual identity makes it incredibly unique. Unlike gold, which is primarily seen as a store of value, an hedge against economic uncertainty, silver has a wide array of industrial applications that drive its demand far beyond its value as a mere investment. This is one of the key reasons why the potential revaluation of silver by the BRICS nations could have such a profound impact on the global market. By recognizing and amplifying silver's true value, these nations could set off a chain reaction that drives demand and prices to unprecedented heights. In today's world, silver is essential for a multitude of industries. It's a key component in electronics, including mobile phones, computers, and televisions, where its conductive properties make it irreplaceable. Silver is also crucial in the renewable energy sector, particularly in the production of solar panels, where it is used in photovoltaic cells to convert sunlight into electricity. As the world moves towards greener energy solutions, the demand for solar panels, and consequently for silver, is expected to skyrocket. Brian London has often pointed out that this industrial demand for silver is a critical factor that many investors overlook. While gold is hoarded and stored, silver is consumed. It's used in products that are essential to modern life. And this consumption means that silver is constantly being taken off the market, reducing the available supply. As London emphasizes, this creates a situation where the demand for silver is not just driven by investors or speculators, but by industries that rely on it to produce their goods. This ongoing industrial consumption adds a layer of scarcity that is often not factored into silver's price, especially when that price is being manipulated downward by powerful financial interests. Now, imagine what happens if the BRICS nations, already aware of silver's strategic importance, decide to revalue it as part of their broader economic strategy. Suddenly, the price of silver doesn't just reflect its value as a monetary metal. It also starts to capture its industrial significance. This revaluation could lead to a surge in demand as industries rush to secure their supplies before prices climb even higher. Companies that rely on silver for their products might begin stockpiling the metal, further driving up demand. Moreover, this isn't just about the existing demand. A revaluation could lead to new applications for silver as its price begins to reflect its true market value. Innovators might start looking at silver as a viable alternative in areas where it was previously considered too expensive. For example, in the medical field, where silver's antibacterial properties are already valued, we could see an increase in its use in everything from bandages to high-tech medical devices. In the automotive industry, where silver is used in electric vehicles, demand could soar as car manufacturers ramp up production to meet growing global demand for clean transportation. The implications of this are enormous. If the BRICS nations successfully revalue silver, they could trigger a global shift in how the metal is perceived and utilized. This isn't just about pushing prices up. It's about fundamentally altering the landscape of the silver market. As London and other experts suggest, this revaluation could finally allow silver's price to reflect both its monetary and industrial value, breaking free from the artificial constraints imposed by market manipulators. But it's not just the industries that would feel the impact. Investors who have been holding silver could see significant returns as the market begins to recognize the metal's true worth. Those who have invested in silver mining stocks, ETFs, or physical silver would likely see the value of their investments soar. This revaluation would validate the belief held by many that silver has been grossly undervalued for years and that its potential has been suppressed by forces beyond the average investor's control. However, London cautions that such a dramatic shift in the market could also lead to short-term volatility. As industries and investors scramble to adjust to the new reality, prices could experience sharp fluctuations. This volatility could create opportunities for those who are prepared, but could also pose risks for those who aren't. It's crucial for investors to stay informed and be ready to act as these developments unfold.
As some claim, on a day-by-day, tick-by-tick basis. I think anyone who claims that it's not being manipulated is getting the whole logical argument wrong. The burden of proof is actually on anyone claiming it isn't manipulated, because it's been manipulated repeatedly, publicly, covertly, and overtly over the decades previously. The government has demonstrated, and governments have demonstrated, that they're perfectly willing to manipulate the gold price at key junctures to progress their policy positions. However, silver's kind of a different thing. You look at the custodian of the big SLV, or rather SIL, gold silver ETF is actually SLV. I'm sorry, is J.P. Morgan, and this is an enterprise that was called a criminal enterprise by the U.S. Justice Department due to its manipulation of precious metals prices around the fix. J.P. Morgan also holds one of the biggest silver positions in the world today, if not the largest, and therefore you're never quite sure, or at least some people have raised doubts as to whether the silver in the ETFs is in the ETF or owned by JP Morgan or moved or ownership transferred at all. So it's kind of hazy subject right there. And JP Morgan and other big bullion banks are very active in the futures markets, the paper silver market, where silver is even smaller than gold in that market and therefore much more easily manipulated. If you look at the various silver price slams, one of which is going on while we're talking right now, they've all occurred between the hours of 9 and 11 in the U.S. market, the New York market. And it seems to be happening again as we speak. That said, silver has relentlessly clung to $30 and above. And the brief instances where it's dipped below that or been driven below that, it's bounced right back up. So I think the silver story is unique in the precious metals universe. I think it's going to leverage gold, and it has always done that in this kind of a bull market, this kind of a gold bull market. I expect it to do so again, but it may do so even more explosively right now because of that structure in the market where shorts are desperately trying to defend their positions. When that dam breaks, I think we could see something really extraordinary to the upside.
History has a way of repeating itself, especially in the world of precious metals. When we look back at significant shifts in gold and silver prices, we can see clear patterns that suggest the current situation with silver might not be as unprecedented as it seems. The forces of supply and demand, geopolitical events, and economic upheavals have all played pivotal roles in driving dramatic price increases in the past. Today, silver is positioned in a similar way, with many of the same dynamics at play that have led to massive bull runs in the past. One of the most notable historical precedents is the silver boom of the late 1970s and early 1980s. During this period, silver prices skyrocketed from about $5 per ounce in 1978 to nearly $50 per ounce by January 1980. This tenfold increase was driven by a combination of factors, including high inflation, geopolitical uncertainty, and a Hunt brothers' attempt to corner the silver market. While the situation today is different in many ways, there are striking similarities that suggest we could be on the cusp of another significant price movement. Brian London often refers to these historical patterns when discussing the future potential of silver. He points out that while the Hunt brothers' manipulation of the market was an extreme example, it demonstrated the volatility of silver and its potential for rapid price appreciation. The current market is similarly primed for a major shift, albeit under different circumstances. Today, it's not just a few wealthy individuals manipulating the market, it's powerful financial institutions, and the stakes are much higher. Another relevant comparison is the gold bull market that followed the 2008 financial crisis. During this period, gold prices surged from around $800 per ounce in 2008 to over $1,900 per ounce by 2011. This increase was driven by a combination of factors, including the devaluation of the U.S. dollar, fears of inflation, and a loss of confidence in the financial system. Silver, too, saw significant gains during this period, rising from around $10 per ounce in late 2008 to nearly $50 per ounce by 2011. London and other experts suggest that the conditions we see today, rising debt levels, geopolitical tensions, and central banks' aggressive monetary policies, are reminiscent of those that drove the previous bull market. What makes the current situation even more intriguing is the potential for the BRICS nations to disrupt the status quo. If these countries decide to revalue silver, they could trigger a price increase that dwarfs anything we've seen before. The historical examples show us that when major economic forces converge, they can create explosive price movements in precious metals. Silver, with its unique blend of industrial and monetary value, is particularly susceptible to such shifts. London also points out that while past bull markets have been driven largely by Western economic crises, the current scenario is different in that it involves a deliberate and strategic move by the BRICS nations to reassert control over their economic futures. This adds a new dimension to the potential for a silver bull market. It's not just about reacting to economic instability. It's about proactively creating a new financial order that could see silver play a central role. Furthermore, the historical context helps us understand that market corrections, when they come, are often swift and dramatic. When the manipulation of a market is finally exposed or becomes unsustainable, prices can correct very quickly. This was the case in the late 1970s, and it could be the case again today. As the pressure builds and more investors and industries begin to recognize the true value of silver, the potential for a rapid price increase becomes more likely. For those who have studied these historical patterns, the current situation with silver is not just a potential opportunity. It's a moment of déjà vu. Investors like Ryan London see the writing on the wall. The combination of industrial demand, financial manipulation, and geopolitical shifts is setting the stage for a silver rally that could rival or even surpass past bull markets. In conclusion, while history doesn't always repeat itself exactly, it often rhymes. The dynamics that have driven past silver and gold bull markets are present once again, albeit in a new form. The potential revaluation by the BRICS nations adds a unique twist to the story, but the underlying principles remain the same. Silver, once again, is poised for a dramatic price shift, and those who recognize the signs stand to benefit greatly. The question now is not if, but when this market correction will occur.
If it's a great project and early on with a good management team, in many cases, I won't worry about jurisdictional risk or as much. Currently, it's a target-rich environment, and I don't think you need to take undue geopolitical risk, jurisdictional risk in your investments. Some people are looking at Mexico right now and avoiding it. I don't think I'd put Mexico in that category just yet. There are some other jurisdictions in Central America that I'd probably avoid right now, and simply because you don't need to accept that kind of a risk. There's great projects that are historically undervalued around the world, in North America, in Canada, the U.S., that I think deserve attention, and you don't need to accept that kind of pioneer risk. You know, the pioneers, the ones that get the arrows in the back. So you don't need to venture too far afield to get.
Silver is notorious for its volatility, and while this characteristic might make some investors uneasy, it also presents unique opportunities, especially in times of significant market shifts. Compared to gold, silver's price movements are often more extreme, rising much faster in bull markets and falling harder in bear markets. This higher volatility can be both a curse and a blessing, depending on how it's navigated. As we explore the potential revaluation of silver by the BRICS nations, it's crucial to understand how this inherent volatility could play a critical role in amplifying the effects of such a monumental shift. Historically, silver's price swings have been far more pronounced than gold's. During the 2008 financial crisis, for instance, while gold doubled in value over a few years, silver's price increased nearly fivefold. This kind of performance underscores silver's potential to deliver outsized returns, but it also highlights the risks. Ryan London often discusses how silver's volatility makes it an attractive but challenging investment. For those willing to tolerate the wild price swings, silver can offer substantial rewards, particularly in a bullish market environment. The potential revaluation of silver by the BRICS nations could trigger exactly the kind of market conditions where silver's volatility becomes a major asset. As these nations move to revalue silver, the initial impact could be a sharp and sudden spike in prices. This wouldn't be a gradual increase. It could happen almost overnight, catching many off guard. Investors who are positioned correctly could see significant gains as the market reacts to this revaluation. London has pointed out that this kind of volatility is not just about market psychology. It's also about the underlying market dynamics. Silver, unlike gold, has a much smaller market size, which means that even a relatively small amount of new investment can have a disproportionately large effect on prices. When large institutional investors or entire nations start buying silver in significant quantities, the price can move dramatically in a very short period of time. This is why silver is often referred to as gold on steroids. It reacts much more violently to changes in the market. Furthermore, silver's dual role as both an industrial and monetary metal means that it is influenced by a broader range of factors than gold. Economic growth, technological advancements, and changes in industrial demand can all drive silver prices up, while financial manipulation and market sentiment can push prices down just as quickly. In the context of a BRICS-led revaluation, we could see all of these factors converge, leading to a perfect storm of volatility. This volatility, while risky, can be incredibly profitable for those who are prepared. Investors like Ryan London argue that understanding and embracing this volatility is key to capitalizing on silver's potential. When the market begins to recognize the true value of silver, whether through a revaluation by the BRICS nations or a broader market correction, the price could rise rapidly. For those who have positioned themselves wisely, this could mean significant returns in a very short period of time. However, London also cautions that with great reward comes great risk. The same volatility that could lead to huge gains could also result in sharp corrections. Investors need to be ready for the possibility of quick pullbacks, even in the midst of a broader bull market. This is where having a long-term perspective and a well-thought-out strategy becomes crucial. It's not just about riding the wave up, it's about being able to weather the inevitable storms that come with such a volatile asset. For the BRICS nations, the volatility of silver might actually be part of the appeal. A sudden spike in silver prices could serve their broader geopolitical goals by disrupting the existing financial order and challenging the dominance of the US dollar. In this context, silver's volatility is not just a market characteristic, it's a potential tool for reshaping global finance. If the BRICS nations can trigger a significant price increase in silver, it could set off a chain reaction that disrupts markets and forces other nations to reconsider their own financial strategies. In conclusion, silver's volatility is both its greatest strength and its greatest risk. In a market revaluation scenario driven by the BRICS nations, this volatility could lead to dramatic price increases, offering substantial rewards for those who are prepared. However, it also requires a strong stomach and a clear strategy to navigate the inevitable ups and downs. For those who understand the game, silver's wild price swings aren't something to fear. They're something to embrace as part of a potentially historic investment opportunity.
Flags come, well, in two areas, the property, the project, and the management team. If it's a management team that I have seen has not operated perhaps as a good faith actor in the past, then I'll avoid that. If it's a project that has some notable flaws, then I may pass on it. Every project has some potential flaws. Where they're located, what regime are they in, or political regime are they in, is one of the clearest risk factors. But in some cases, the project makes up for that because it's so extraordinary, and you can see that a discount may not be may be exaggerated for a project like that. So you look at a host of characteristics for each company and each project. But at this point in my career, I know just about everybody in the industry, or know somebody who knows them very well. So I like to say I have kind of a network of spies throughout the industry, and the advantages of finding or subscribing to newsletters where people, the editors have a lot of experience in the industry, and there are a few out there that I recommend in the free report on our website, is that you get advance notice of the next big things that are coming into the market. That's particularly important and advantageous in the kind of market we're going into, that is a bull market, where getting in early on a company that's with good projects, that has a management team that can really advance it and get a lot of attention from the market, that's key, and mitigates the risk in what is, let's face it, a very risky sector.
If the BRICS nations move forward with their plans to revalue silver, the consequences could be far-reaching and potentially transformative for the global financial system. Such a move would not only disrupt the manipulation of silver prices that has persisted for years, but could also lead to a cascading series of events that dramatically increase the metal's value. The revaluation of silver by a coalition as powerful as the BRICS nations could set off a chain reaction in global markets, driving up prices and forcing a rethinking of silver's role in both industry and finance. One of the immediate outcomes of a successful revaluation would be a sharp and sudden increase in silver prices. The BRICS nations, by revaluing silver, would signal to the world that they see it as an essential asset, not just for industrial purposes, but as a cornerstone of their economic strategy. This would likely lead to a surge in demand as investors, industries, and even other nations rush to secure their own supplies of silver before prices rise even further. Brian London has often emphasized that silver's price is highly sensitive to changes in demand, particularly given the metal's relatively small market size compared to gold. A sudden influx of buying interest could push prices up rapidly, potentially to levels that have not been seen in decades. The impact on global markets could be profound. For one, the revaluation of silver would likely lead to increased volatility, not just in the silver market, but across all precious metals. As silver prices climb, investors might begin to question the relative value of other metals, particularly gold. This could lead to a broader reallocation of assets as markets adjust to the new reality. Additionally, industries that rely heavily on silver, such as electronics, solar energy, and automotive manufacturing, would face higher costs, which could have ripple effects throughout the global economy. These industries might be forced to pass on these costs to consumers, leading to inflationary pressures in certain sectors. London suggests that this revaluation could also serve as a wake-up call for investors who have been complacent about the potential of silver. For years, silver has been overshadowed by gold, seen as a secondary option rather than a primary investment. But if the BRICS nations successfully revalue silver, it would force a rethinking of this perspective. Suddenly, silver would be seen not just as the poor man's gold, but as a vital asset in its own right, capable of delivering substantial returns. This shift in perception could drive a new wave of investment into silver, further fueling its price increase. Moreover, a revaluation by the BRICS could trigger a geopolitical shift in how precious metals are viewed and traded globally. If silver is revalued as part of a broader strategy to move away from the US dollar and establish a new reserve currency, it would signal a major realignment in global economic power. Other nations, particularly those in the developing world, might see this as an opportunity to align themselves with the BRICS and diversify their own reserves away from the dollar. This could lead to a decline in the dollar's dominance in global trade and finance, with silver playing a key role in the emerging multipolar financial system. For individual investors, the potential outcomes of a successful revaluation are both exciting and daunting. On one hand, those who have invested in silver could see significant gains as prices rise. This would validate the belief held by many that silver has been undervalued for years, and that its true potential has been suppressed by market manipulation. On the other hand, the rapid price increases could also lead to heightened volatility, with sharp corrections possible as the market adjusts to the new reality. Investors would need to be prepared for these fluctuations and have a clear strategy in place to manage their risks. London advises that in such a scenario, it's crucial to stay informed and be ready to act quickly. The revaluation of silver could create opportunities for significant profits, but it could also create risks for those who are unprepared. Investors should consider diversifying their portfolios, perhaps by holding both physical silver and silver-related assets like mining stocks or ETF, to mitigate the risks associated with such a volatile market. In broader context, a successful revaluation of silver by the BRICS nations could also lead to increased scrutiny of the practices that have kept silver prices artificially low. Regulators and governments might begin to take a closer look at the manipulation of the silver market, leading to tighter controls and greater transparency. This could further support higher silver prices in the long term, as the market becomes more reflective of true supply and demand dynamics.
It's very inefficient, and you can gain advantage by just exploring it, learning about it, and trying to find the bargains that the market temporarily overlooks. However, and there's nothing wrong with that, if you don't have the ability or desire to put that kind of work in, you can simply buy the indices, GDX and GDXJ, and you'll still do very well in this market, just not as well or not explosively well as some of the juniors will do. But within the miners themselves, there are a few things I think I like more than others. I think silver will outperform again, and therefore the junior silver miners and explorers and developers will do very well. That's proven to be a tried and true method of leveraging silver, which in turn leverages gold. So you're building leverage on top of leverage. I think companies with large identified resources, some of which already have economic supply to them, are going to benefit better than others, at least initially, in this bull run. One of the factors I think is coming to the fore is M&A in the sector. The major miners are starting to report their quarterlies, and we're going to get an idea of what their margins are right now. But we know that the gold price has been rising more quickly in recent months, this quarter particularly, than miners' costs have been rising. Barrick just reported today, and that proved from their quarterly filings that their costs have only risen by about 2% over the quarter, but the gold price has done much better than that. So the miners understand better than anyone else what's happening with their margins. And I think they're starting, and it's been proven out with a few recent news releases, they're starting to make big moves in the mining sector. And I think that feeding frenzy that we were hoping to develop is really imminent at this point. I think those companies, the juniors that have those big deposits, are going to be the first to go. And unlike the experiences of the past few years where we may have buyouts at maybe a 20% price premium and half of an all-time high for a junior.
As we've explored, the BRICS nations' potential revaluation of silver could trigger a significant and lasting increase in silver prices. By challenging the current financial order and recognizing silver's true value, these nations could set off a chain reaction that sends silver soaring to new heights. For investors, this presents a rare opportunity to capitalize on the major market shift. Imagine the impact. A surge in demand from these powerful nations could overwhelm the manipulation that has kept silver prices suppressed for so long. This could lead to a rapid price increase, turning silver into a highly sought-after asset both industrially and financially. Those who are prepared, whether through physical silver, mining stocks, or ETFs, could see substantial gains as the market corrects. However, with this potential comes volatility. Prices could swing dramatically as the market adjusts, so having a clear strategy is crucial. But for those ready to take the plunge, the rewards could be extraordinary. We're on the brink of a potentially historic shift in the silver market. If you found this discussion valuable, be sure to subscribe to the channel for more insights and updates on this and other investment opportunities. And remember, while the potential is exciting, always do your own research or consult a financial advisor before making any investment decisions. Stay informed, stay prepared, and you could be in the right position when silver's time finally comes.
Potential speculations, and you want to, if you're in the sector, you want to focus most of your capital on the more solid, less riskier uh, uh, plays. Now, all that said, there's the entire sector offers what would be regarded as really exceptional upside potential for any other investment sector, really across the board. Now, this is one of those areas where I tell people, do as I say, not as I do, because I'm just ridiculously overweight in the juniors, because I know the sector so well. I have a good part of my personal wealth invested in it. And a big part of it is knowing the teams. I will more heavily allocate towards projects where I see a lot of potential in the project, and I really like the management team, and I know they're going to do the best job they know how, and they are very capable and can raise money, and all that because they have, more important than money invested in the company, they have their reputations on the line. And the groups, some of the groups I've been talking about, that's more important than money at this stage in their careers. They want to have another success. They want the market to see that they've had another big success, and they're going to make it work for the shareholders. Successes, and notable by their absence or some of their failures that I'm well aware of. So you need to dig more, Google the names, look at the histories. This is where having some newsletters, subscribing to some of the better newsletters really comes into play. If you subscribe to some of the better newsletters and you see some common names among those listed in their recommendations, then you can have a bit of a better feel for the fact that someone has looked at it that's very knowledgeable about past histories. The market's evolved not recently, I guess over the past 10 years or so, and even more so over the last 5 years or so, that there are some groups out there that are have a family of companies under their wings, common management that finds good opportunities, puts it in put those opportunities in companies, assembles really good management teams, and they have a common thread. They share offices, they share some management and directors, but these are people that are putting their own money in. They've had successes in the past, and they're basically keeping it rolling and using their expertise to bring new plays to market. There's about 3 or 4 of those prominently operating in today's market. And there are other groups that only have 1 or 2 companies under their wings that do really good jobs. And it's a case of of experience and doing your homework to figure out what those are. A great way to do that is to go to conferences and talk to other investors, talk to management teams face to face. Ask them what their plans are, the likelihood, what their plan Bs are, what are they going to do if things don't work out. If a project doesn't work out, which odds are it won't become a mine at least, then what's their next project? What's their next thing down the line? There's a lot to the sector, and education is a key, because again, it's a very risky sector. It can be highly rewarding, especially in the kind of market we're getting into now. But it entails risk that you have to be able to handle significant losses in some positions. And when you have significant gains, you have to be smart enough to take profits as well.